Hey everyone, Chris Haddon, Jason Balin here with the Private Lenders Podcast. As always, sponsored by our lending company, hardmoneybankers.com and hardmoneymastermind.com, where private and hard money lenders from around the country get together to share ideas, learn from us, study our courses, everything else. So feel free to check that out, hardmoneymastermind.com. Today we're talking about an interesting topic, a good one. It's called the Plan B lender, and there's nothing wrong with being a Plan B lender, and I'll explain to you what I mean by that. So back in the day, this wasn't really the case I guess it was in terms of banks and everything else, but especially we're talking about the institutional money. So there's a lot of money out there for investment real estate deals. Could be institutional backed hard money lenders, could be banks, could be credit lines. And that could be one of your clients, one of your borrowers' plan A's because it's cheap, right? And if for some reason that financing doesn't work out or can't get to the closing table on time, they might need a plan B, which is you and which is us. And we're going to tell a few stories. We pick up deals all the time, every week, because financing from some other source fell out. We're the plan B, and we promote that. Like, we're not like shy about it. Like, I even sent an email broadcast today saying, if you need to close on an acquisition, even construction aside or permanent financing aside, keep us in mind. Keep us in mind as a plan B. We can close within a couple of days. Basically, whenever title's ready, we can be ready. And you can really pick up quality deals and quality borrowers with that strategy.
Yeah, I think the best part about being Plan B, and it's pretty descriptive what it means being a Plan B lender, is by the time they come to you, they need to close, and they need to close quick. They're not as price sensitive. They're not as rate conscious. It's just like, hey, we need to close. Can you close quick? And you come in and you save the day, and it turns into potentially a repeat borrower by doing it. Like, there's so many positive things about being a Plan B lender. And, like you said earlier on when we started years ago, 07, 08, 09, 2010, things like that, most hard money lenders had the same product. We were all similar in pricing. So it didn't happen as much, or it would only happen if someone ran out of capital. That was actually one of the reasons it would happen back in the day. Another lender would run out of capital, and then they'd come to us, who was well funded to do it. But now it happens a lot. It happens all the time. And since COVID, it happens more because, think about this. So, and this happens all the time. I get rejected all the time, mostly because our loans are too conservative and our terms are too high, right? And that's fine. And as a private lender or hard money lenders, yours should be too, right? If you're doing a ton of volume, I would recommend upping your price. And you're probably lending too aggressively and not charging enough. So anyways, it goes like this. Someone calls me, we go through it. I build a really good rapport with them because that's important, because this whole business model is a long play. It doesn't happen overnight. It's a long play. And I know that if we don't do a deal for them today, we might do a deal for them tomorrow or down the road, or who knows, 10 years from now. We go through everything, go through price. Typically the conversation's like, yeah, it's a little bit more than I wanted to spend. Or it's a little bit more, 13% and 3 points. So it's a little bit more expensive than they want to be. And their cash to close is more than they prefer, right? So then typically it's not a good match. And I understand that. So they try to find an institutional back lender. We all know institutional back lenders. They're getting back end bank financing or Wall Street money or other leverage, and they're lending out, I don't know, anywhere between 8 and 1, 6 and 1, and 10 and 2, maybe. I don't know. It's not somewhere around that, but significantly cheaper money. Like, I don't fault somebody for not wanting to try to go that route. Right? It's a good big difference in price. So they go down that route, and keep in mind, you're not dealing with the principal of a company like they're dealing with Chris or myself, or with you who's listening to this. They're dealing with a sales rep, typical sales rep, who, I don't want to say they're a yes man and they're misleading them. That's not the case. But they don't know the areas. We all know the areas, right? We only lend locally. So what happens? It's like, okay, well, let's order an appraisal. This is what we can do. We can lend you 90% of the acquisition, 100% of the construction. This is your estimate cash to close, blah, blah, blah. Let's order an appraisal, and then we'll go from there. So, well, what's wrong with that? That means that if it's not fully approved, it's not fully committed to, it's not fully ready if they have to wait for all those things. So what ends up happening, they order an appraisal, and then they come back to them and say, hey, we can't lend what we thought. The appraisal came in lower, or this came up in underwriting, or this came up in underwriting. And you don't know until weeks later, right? When we talk to somebody, by the time we commit to them on a loan amount, we've already pre-underwrote it. So for the most part, we're comfortable with what we're lending. right? Nothing's going to change unless something drastically happens. Nothing's going to change. But on those deals, it's just hearsay. They're just basing it off of the investors, the real estate investors' numbers first. And then what happens is, appraisal comes in, they have to lower the amount. It wasn't what they're expecting. Maybe they up the rates. Maybe something happens, and it's like, well, I can't make this deal work anymore, or they just get turned down. Then they come back to us. We're plan B. And by that time, it's great. Like, you're the savior. Well, you're the savior. It happens all the time. It's like, Jason, oh my God, I got this deal. I need you to call me. It has to close tomorrow, or it has to close Friday, or it has to close Monday, or whatever the case is. It just fell out last minute. And lots of times they have big earnest money deposits that they could potentially lose. Mm-hmm. So you come in and you save the day, you close the deal, and hopefully you have a client for life, but you certainly have a really good deal.
Yeah, I mean, we have one longtime client who has a cheaper source of money from a national lender. And whenever that works, he goes with that probably 80% of the time. And then maybe 20% of the time he comes to us and he knows our terms. He knows we close quick, and it's fine. It's totally cool. Another example that I thought of that happened recently was that credit score change. So one new borrower borrowed several times from a national lender at like a 680 credit score, something like that. For whatever reason, maybe they ran up their credit cards or something like that, high revolving balances, that credit score dropped from 680 to 650. And even though it's a repeat client, they couldn't lend to him anymore, right? And so we got to quote a really good deal. Hopefully it closes. We got to quote a really good deal for a well-qualified borrower just for that one change, right? And so that's an area where you can fill in too, if you control the capital. And, and something else I was thinking about when you were talking about some of the competition, the cheaper money, and how they're not talking to a principal of the company. They're not even talking to an underwriter, the person they discuss their deal with. It's an originator who is not at all involved in the underwriting and approval of loans. That's right. Different than us, and hopefully different than you. They're talking to, we're owner of the company, but we also underwrite and approve the deals. So they're talking to a completely different person in the operation about a loan they need to close, right? Mm-hmm. And that puts you in a great spot, great advantage versus the competition.
Yeah, true. I mean, there's endless stories. This has been happening since we've started, being plan B of one way or the other, from no capital to getting turned down or lower credit score. But that's true. Like, some of these are credit driven, right? And the interesting part is sometimes they'll call back and be like, hey, I'm ready to go with you guys now, but you got to match these guys. Like, I'm not matching them. Like, we do 13-3. It's like, but I want to give you the business. It's like, you got turned down somewhere else. Like, that's the reason. Every time they come back, they're getting higher terms, and they're getting they're getting higher terms than what they originally quoted from this other company, because we're 13-3. We're more expensive, and typically a lot more money down. So, I don't know. I never loved the business model of the institutional capital. And I think that as markets change, capital markets change, the market as itself softens, it's going to be harder. It's going to be harder. I mean, to get deals through that way. So a big thing to think about is just make sure you're into this. We talk about marketing all the time. Make sure you're into this game as the long play. Anytime someone calls you, give them the information, treat them right, collect all their information. You have to get their email address and stay in front of them. And you automatically stay in front of them. If you've ever done private consulting with us, one of the things we put on our to-do checklist that isn't negotiable, that you have to do, is every Thursday or every Friday, you have to send an email blast out, at least one email blast out a week to your list. And that's part of it. Everyone goes on the email list, right? So you catch them at the right time. There's not one week that does not go by or hasn't gone by that we send out an email and then we get a response that says, oh, I do need you now. I forgot. Or, I have a deal that just, that just fell out. I mean, and this doesn't happen all the time. I probably got 4 or 5 calls today alone already today within the last few hours of either from brokers or borrowers that a deal fell out and they need to, they need to close quick. They need to get the deal done quick, and it's fine. And I understand that we're, might be a little bit more well-capitalized than you, and maybe not, but some, if you're newer, you might not either have the capital available or have the confidence to underwrite a deal that quick, but that's okay. We have confidence that we'll usually tell people, sure, we'll close tomorrow, the next day, if everything's done, send me everything, but you don't have to. Buy time. The deal's they already don't have another option, right? So they're going to go beg to the title company or beg to the seller to buy themselves some more time, push it out a week, push it out, whatever the case is. and then do the deal. But you'll look like a hero, and it's a good feeling, and it works. And I mean, I'll tell you, there's a lot less. They're easier deals. I mean, yes, you got to work quicker on them, but they're easier deals because they're not going to beat you up on price or stuff like that. It's like, this is what we can do. It works. I'll still close it for you next Monday like you need to.
Yeah, absolutely. So I think one of the takeaways should be like, don't be shy about putting that out as marketing messaging. Like, if you need a plan B, I'm here, that sort of thing. And they do come back around, and it could be from a few months ago. And like, sometimes deals take a while to ratify, or like auction contracts, something like that. And our business partner, Ian in Philly, calls them zombies. You ever heard him use that term before? So zombie.
Oh, because they just disappear?
Because they died. The deal died a couple months ago. And then like a zombie, they come back to life and they need you again. And so these zombies come back all the time. They pop up, something that you quoted a while ago, and they went to get what they thought was a better option, didn't pan out, and now they're back. Now the deal is back alive. And it happens frequently at the end of the month too, because real estate runs so much on like a month-to-month basis. And the last week of the month is always the busiest in terms of settlements. So without fail, around the end of the month, I mean, granted, we get the leads all the time, but the actual closings like pop up in that, last 10 days of the month, something like that. I need to get this done by the end of November or whatever it is. Good opportunity to pick up a few extra deals, round out that month. It's nice. And I definitely recommend that you keep that messaging in mind when you're putting stuff out on social media or an email broadcast, that kind of thing. Like, nothing wrong with being a plan B lender.
Yeah. And as you grow your portfolio, a few deals a month will always be like that. And it's great. And it works. But you don't need to match whatever they were going to get before. That deal is off the table. Stick to your guns, make it work, and, do the deal that you're comfortable with. I mean, I have no problem if, I don't care how strong that borrower is or how many deals they've done or whatever. Like, there's a number that's going to work for us, and that's what we're going to quote, and that's what we're going to stick to. And, that's where it's at. Get used to people telling you no, investors telling you no. And then, eventually they'll come back. Not all of them, but some of them will come back and they'll say yes, and you're good to go.
Absolutely. I mean, it's a fantastic model when you control the capital and you are lending at the spreads that you want.
And no one's closing a deal as quick. If you have the capital available right now already between private capital or your own capital, nobody is closing a deal 1 or 2 days. Like, you have that. Use that as, an engine sales tactic as well. If you have the ability to, obviously, like, use that to do it. Every deal is like, hey, we can close as soon as title work's done. As soon as title work's done, we can close. As soon as title work's done, like, push speed. It goes a long way. Yeah.
Great way to pick up deals and to keep your terms. Lend at the points and the rate that you want, and also the loan amounts that you're comfortable with to do safe deals. And using the strategy, you'll pick up stuff every month, guaranteed.
Yep.
Okay, cool. Yeah. Anything else to add on?
No, I think we're good.
Good deal. All right. Well, if you like the podcast and want to learn more, check us out at hardmoneymastermind.com. We hope to see you on the monthly training calls, and we will see you next time on the podcast.